Hi, good afternoon. Thank you. Thanks, Prem, and thanks, Anita. It's always a pleasure to be on the Cafe Mutual platform. The alpha hunt puts a lot of onus on me. So right up front, I'll put a disclaimer. I don't think the alpha is dependent on the structure, whether it's mutual fund, PMS, or AIF. At the end of the day, we're here to deliver alpha. We need to beat the opportunity cost of the investor, who can obviously buy low-cost index funds. So the alpha need for alpha exists despite the structure. Having said that, there are ways, like Prem mentioned, where you can use that relatively light regulation on a PMS or AIF to engineer that, but that's not free lunch. It comes as its own cost. So just briefly, in terms of who we are, Marcellus is a 7-year-old asset management firm. Like I said, I'm one of the founders. We manage about $500 million in assets, predominantly in public markets, both India and global. We manage money for Indian families in Indian public equities through PMS and AIF, as well as global equities, predominantly US and Europe, again through PMS and AIF out of Gift City. We also manage money for some of the largest global institutions, a pension plan in North America, a European church, a British university, primarily for Indian equities. Now, before we get into what PMS and AIF and how it can add value to investor portfolios, for the uninitiated, what do they actually mean? A mutual fund is a collective investment scheme with collective ownership of stocks, whereas a PMS is a segregate account where the client owns the stock in their own demat custody with a power of attorney to the manager to manage that account. An AIF is also a collective investment scheme. However, it has flexibility to invest in multiple different asset classes, predominantly private credit, much like what Rachna talked about, venture capital. This is perhaps the fastest growing and the largest category here. We'll talk about those pieces as well. Now, right up front, I'll lay the truth of the land. Clearly, mutual funds increasingly are becoming more and more tax efficient as compared to PMS and AIF. Particularly in the context of public equities, which run diversified portfolios with a relative high churn. You need to be a superstar fund manager in a PMS to offset the tax hindrance you'll get and compete with a mutual fund. So why then should we even consider PMS and AIFs? I reckon the answer to most of the questions around investments should start with asset allocation. I think if you look at it through the lens of asset allocation, a lot of answers would emerge on its own. The way I would see it, because Prem said mutual funds are relatively tightly regulated, one of the biggest differences is there is a cap on a single stock holding. Therefore, you necessarily tend to run diversified equity portfolios. Most diversified equity portfolios tend to be restrictive in terms of their ability to take calls in terms of really concentrated holdings, letting your winners run. And therefore, a lot of the mutual funds tend to have very much index tracking sort of returns. I'm not belittling any of the other mutual funds. There are a lot of great mutual fund managers who've delivered alpha over long periods of time. But from an asset allocation perspective, I would reckon diversified equity mutual funds should form the core of anybody's asset allocation. That'll give you the beta. At the end of the day, those investments are meant to achieve certain objectives, which is defined by asset allocation, which also means that the PMS and AIF becomes a restrictive market. I reckon anybody with less than 5 crores of financial net worth should not be considering PMS and AIF. Partly because it sort of messes up your asset allocation, given that the PMS ticket size is 550 lakhs and AIF is 1 crore. Most people with 5 crores and below financial net worth can achieve most of their financial objectives through mutual funds. So it's only in the category of HNI, ultra HNI, with 5 crore plus financial net worth that the PMS and AIF can actually add value. How do they add value? Now, the asset allocation is simply not about investing in different asset classes which generate high return. the more important aspect of asset allocation is investing in asset classes which are very lowly correlated between them. That's when diversification becomes a free lunch, right? So with your core portfolio being mutual funds, can you find PMS strategies or AIF strategies which have relatively low correlation to the core, right? And why is this low correlation important? I think you go back to the work of Harry Markowitz in the 70s. Harry Markowitz eventually ended up winning the Nobel Prize, from which the oft-quoted adage of diversification is the only free lunch in finance. What he meant was when you create a portfolio where its individual constituents have very little correlation between them, i.e. when one goes up, the other goes down, and so on. Not necessarily negative correlation, but a low correlation. You achieve two things. First is quite intuitive. The portfolio remains less volatile, and we all know the importance of low volatility because often client behavior becomes even more volatile with the volatility of the underlying portfolio. So deep drawdowns trigger panic selling, and you end up getting out of an asset at the worst time. Putting together a bunch of assets which behave very differently in different points in time means that the overall portfolio is relatively consistent and stable, therefore drives a much more responsible behavior on behalf of the client. But that's only half the truth. Reduction in volatility is only half the truth coming from diversification. What it misses is this reduction in volatility comes without any compromise in terms of long-term returns. This is the free lunch, because often we are told high risk, high return. The moment I talk about lowering the volatility, which is risk in common parlance, people assume that this reduction in volatility is coming with reduction in long-term returns. Whereas in reality, a portfolio of uncorrelated assets, which when systematically rebalanced, actually delivers pretty much the same returns at half the volatility. I think at this point in time, if you look at, say, two mutual funds in India, I think it's HDFC FlexiCap, which is 100% equity, and ICICI Prudential, which is a multi-asset fund, which invests across asset classes. You'd be surprised to see that the 20-year returns are identical. I mean, there's no bigger proof in terms of seeing that that diversification across asset classes, including asset classes like fixed income, gold, real estate, which might have lower returns from a long-term perspective compared to equity, yet doesn't compromise on long-term returns because it allows for systematic rebalancing at times of drawdown. You know, I've met a lot of clients who say that, look, I'm a long-term investor, and I'm a mature investor. I've seen many drawdowns. I don't panic. Therefore, why should I even bother looking at other asset classes which lower long-term returns? And my point to them has been that, look, great, it's fantastic. If you behave yourself during your drawdown, do nothing, stay invested, brilliant. But that's not enough. What do you do in a drawdown? What is the best thing to do in a drawdown? You've got to buy into that drawdown. And if you haven't got dry powder in any other asset class, which is not going through the same drawdown, where do you pull in that dry powder from, right? How do you buy into that drawdown? So systematically rebalanced, well-diversified portfolios tend to add significant value by reducing the volatility without compromising on returns. Now, in the context of PMSs and AIFs, where is that low correlation coming from, right? How do PMSs and AIFs add low correlation to overall portfolio? So let's start with the PMS. What are the key advantages of a PMS? One of the things I talked about is the single stock holding cap in a mutual fund, right? Every time a mutual fund sees 10% of its portfolio being met by a single stock, it'll have to start trimming. And I've seen great mutual fund managers who pitch some great stocks which are multi-decadal compounders, but the only thing they've done with that stock is every time they've just sold it because the stock keeps compounding and keeps hitting the 10% limit. Most great fund managers, if you speak to them, they honestly admit their biggest mistake is not buying bad stocks. It's always been selling great stocks too early. And the mutual fund imposes this restriction on you. Whereas in a PMS, where there's no single stock limit, you can let your winners run as much. Literally, you can have a single stock in your entire PMS portfolio. And that, I think, particularly for the HNI segment, is becoming an increasingly big need. A lot of HNIs want to see managers demonstrate their stock picking skills. Build me a 5-stock portfolio is something that I often hear from HNIs, right? You can't do that in a mutual fund. So one is the concentration of the portfolios. The second is customization, right? People have specific needs, particularly in the HNI community. Now, this could include something as simple as, I don't want any alcohol companies in my portfolio. In a mutual fund, you can't do that. Whereas in a PMS, you can have negative securities. More importantly, customization based on the client's own asset allocation and needs in terms of risk-return combination can be achieved through PMS. The third is important and less appreciated, right? In a commingled structure where you're pooling different investors together, you are subjecting one investor to the behavior of the other investor, right? Particularly in deep drawdowns. Say a small cap mutual fund. Small caps tend to be extremely liquid. In times of crisis, when small caps fall and the fund sees a lot of redemptions, often the fund manager is compelled to sell some good quality stocks, because those are the liquid ones, which means that the other investor who choose to stay invested in the fund also suffer, right? It's not my actions which is making the portfolio less optimal for me. It's the actions of other investors in the fund which is forcing me to sell good quality stocks at a time of distress when I actually should be buying them. Whereas in a segregated PMS, the entire portfolio is yours. It doesn't matter what other investors are doing. As long as you demonstrate the maturity to stay invested, your portfolio is as intact as it can get. In fact, the portfolio manager has the ability to buy into that drawdown much better. There's also a concept called non-discretionary PMS. It's a little bit of a misnomer. Non-discretionary means it's neither at the discretion of the fund manager or the client, where both need to sign off on an action in the fund or in the portfolio. This sometimes, while not always recommended, not everybody has the ability to influence the fund manager decision. But there are some investors who bring in their own perspectives, and at instances, it can create a very collaborative approach between the portfolio manager and the client. And it also aligns interests. Mutual funds, remember, are not allowed to charge performance fees. By default, it's management fees. Now, that drives a different set of behavior, because for the manager to earn more money, you necessarily have to grow your assets, which is why most mutual funds globally, not just in India, are accused of being asset gatherers, whereas in a PMS, you're allowed to charge performance fees. In fact, we at Marcellus take pride because we were the first PMS to offer a zero management fee option, which meant that we told our clients that we don't want to earn money if we can't help you make money, right? There have been years when we haven't delivered the performance and we haven't collected fees. More than actually implementing it, I think it's a sign of conviction, and you can express that conviction to the client that I'm totally aligned to your interest. And the last piece is increasingly, as realization that asset allocation is important comes through with most investors, depending on how do you allocate to large cap mutual funds versus small cap, value mutual funds versus quality, gold versus equities, fixed income, REITs, and so on. A lot of HNIs would want you to manage this asset allocation at your discretion, because how much you allocate at the baseline is one thing, but like I said, diversification is only half filled unless you do systematic rebalancing. Now, if you want to do systematic rebalancing and every time you get clients' approval to switch from one asset class to another, it becomes sort of full of friction. Instead, a PMS becomes a vehicle to manage the client's entire assets by buying mutual funds into into that PMS account and manage it entirely at the discretion of the fund manager. So these are clear value adds where you don't have to get bogged down by the fact that it's a tax inefficient product for largely diversified equity portfolios. There are other scenarios where we can still justify the existence of PMS in the client's asset allocation. Similarly, for AIF, there is scope for running differentiated investment strategies. The AIF goes one up over the PMS because you can have a hard lock-in. We all know clients who think that they are long-term investors, but often their behavior suggests otherwise. A hard lock-in forces that long-term invested behavior, which in turn helps the client, of course, also allows the manager to not worry about redemptions at the wrong time, and that in turn affecting stock selection. The alignment of interest helps here as well. You can charge performance fees. Unlike the PMS, it allows for fractional ownership, much like a mutual fund. It also allows the fund manager a little bit of leeway in terms of efficient allocation across the portfolio. But the biggest advantage of AIF is a lot of new emerging asset classes. We heard Archana talk about private credit. Venture capital is a big growing asset class, venture debt, and real estate. All of these can be launched in an AIF structure. Now, from distribution perspective, how big is the opportunity? The mutual fund is almost getting close to $1 trillion in assets under management, but the PMSs and AIF are no small either. I think both of them are close to about 200 billion, depending on what you count. The PMS is 40 lakh crore, of which 30 lakh crore is the government's EPFO money. Even if you exclude that, it's about 10 lakh crores, which is still a large amount of money. AIF Cat 3 alone is about 3 lakh crores, but if you include venture debt and all the other asset classes, it's substantial. So from a pool of fees and hence commissions, it is something that is quite substantial and the distribution community should not ignore. Now, just to conclude what kind of PMS makes sense, these are the three areas we are concentrating on. First, like I said, a whole host of Indians need a productized version of an asset allocation service. They trust you to choose the assets, they trust you to systematically rebalance at your discretion. So this, in all likelihood, this is a PMS of AIFs. I can buy equity mutual funds, debt mutual funds, gold ETFs, REITs, InvITs, create a truly diversified portfolio and yet manage it at my discretion as opposed to the clients. Second, this is something that we've always specialized in right from the outset. We specialize in running concentrated portfolios. Most of our standardized portfolios are no more than 20 stocks, more often like 15 stocks. We do manage some non-discretionary customized portfolios which are no more than 5 stocks. In fact, for a university endowment, we run a 6-stock portfolio, right? And that's something that clients prefer for us to express our stock picking skills rather than portfolio construction. And the third is very unique. We were one of the first few PMSs to start a global portfolio PMS out of GIFT City, right? And this is particularly attractive for clients in this jurisdiction because these PMSs which we manage invest in US and European stocks. And if you are an NRI from, say, Dubai or GCC country investing in a PMS which invests in global stocks out of GIFT City, it's entirely tax-free because the Indian taxman says either the asset needs to be a resident Indian asset or the owner, which is the client, needs to be a resident Indian. In this case, neither is, so therefore it becomes totally tax-free. We launched this in 2022. It's got a 3-year track record. It's compounded about 25% dollar terms. That, we reckon, is becoming an increasingly attractive proposition for a PMS. For the AIF, similarly, there are 3 sets. I don't need to talk about private credit. I think Archana has talked a great deal about it. But I must talk about venture capital. I think given what we've seen over the last 3 years, there's almost a freeze in terms of private corporate capex. Right? This is a worrying bit for the country because there's only so much of capital allocation the government can do. But refreshingly, we can see a lot of hyperactivity on the entrepreneur side from the startup stage. There's a plethora of venture capital funds available. I know some of you might accuse what has Indian VC produced, is it Zomato and Swiggy that we are proud of? But I must say a lot of the seed stage fund today are doing some really cutting edge deep tech stuff, right? Deep tech including space tech, EVs, battery technology, mobility, and so on. I know we don't have anything to claim in front of the innovations coming from US and China, but these sort of investments today, sooner or later, I reckon in the next decade, you will see India coming out. And this activity of seeding early stage ventures, it's not just rewarding from a returns perspective, but also greatly contributing to India's development and entrepreneurial activity. Real estate is something that you'd be familiar with. So yeah, I mean, that's it. Happy to take any questions.
This is the one which in turn invests in a Cayman fund, is that right?
Right. So in GIFT City, we have two structures.
Tell us a bit more about it, yeah, please.
Sure. So, so we have a master feeder structure out of GIFT City. The feeder fund is a Cat 3 AIF in GIFT City, which in turn feeds into a master fund in Cayman. The Cayman fund in turn buys the stocks in our portfolio, the likes of Microsoft, TSMC, ASML, and so on. What this does is three things in terms of advantage. One, because all the stock level churn is in Cayman and Cayman is tax-free, you eliminate any sort of fund manager action-driven churn. Therefore, you're literally subjected to investor-driven churn. Now, because an investor ultimately needs the liquidity, at some stage the investor has to redeem. The redemption will happen at the feeder stage. But what we've done is ensure that the redemption doesn't happen in the 24-month window, which qualifies as short-term capital gains, by putting in a 24-month lock-in. Therefore, if the feeder fund doesn't have any need to redeem the units of the Cayman fund, there is no incidence of short-term capital gains tax whatsoever. And the difference is massive because in India, for Indian residents at least, the tax treatment of foreign securities at short term, which is 24 months and below, is something like 42%, and long term is 12.5%. So the fund still pays 12.5% long term, but that's no different from any of your domestic mutual funds. In fact, the tax administration is easier because here the tax is at the fund level. The client doesn't need to do anything.
My question was more about from an NRI perspective or from a foreign corporate perspective, not the tax part of it, but where does it invest? And given the tremors about NVIDIA and last night's report, is there an exposure to the top 6-8 stocks in the tech sector in the US?
Yeah, so no, I mean, this is a fund we've launched 3 years ago, so we've made a lot of money in tech, but about a year ago, we thought that things are getting too frothy. We've gone underweight on tech. Tech is still a 32% exposure, but in tech, we've always taken a pick and shovels approach, like a neutral arms dealer, right? So we don't know if ChatGPT is going to win the race, or Gemini, or Llama, or Anthropic, or Perplexity, but we do know all these models will need to run on hyperscalers' cloud, right? So we do own all three hyperscalers, Microsoft, Amazon, and Google. At the same time, we don't know if NVIDIA will get disrupted. Today, NVIDIA has got a distinct competitive advantage due to its CUDA software, which is used by all developers who want to build anything on GPUs. But soon enough, Google's TPUs will give them a run for their money, which is already happening. AMD's come up with something. So again, we're pretty clear that semiconductors will be ubiquitous in our lives. 10 years down the line, 20 years down the line, it'll only become even more ubiquitous. The way we decided to play semiconductors is through two monopolies. What we do know is every NVIDIA chip gets manufactured at just one factory, run by TSMC, the Taiwanese semiconductor manufacturing company. Whether it's NVIDIA's chip or AMD's chip, or eventually Intel, Google will have to make these chips there. So we own TSMC, right? So we're winners irrespective of who wins the semiconductor race. And the second way we've taken the semiconductor call is through ASML. ASML is a Dutch company which spun out of Philips a few decades ago. They make perhaps the most important part of the semiconductor manufacturing process, which is called the extreme ultraviolet lithography. This is a process where those tiny nano-sized circuits are etched on wafers. That is perhaps the most sophisticated technology you will see. In extreme ultraviolet lithography, ASML has a 90% market share globally. So these are two virtual monopolies. We don't need to take bets on who will win, whether it's ChatGPT or NVIDIA, but we play the whole story together. Yet, we've sort of reduced allocation because we think it's a little frothy. Where we do think there's an opportunity and we have a bit of a competitive advantage is in industrials. And remember, Trump and literally the rest of the West is trying to reindustrialize the West. Through COVID, they realized their over-reliance on China to be the factory of the world was hurting them. So they did want to bring back industries to America. We have a disproportionate allocation to industrials in the US. Industrials, unlike tech, are very unglamorous. So they don't hit the headlines. You and I wouldn't have heard of most of these companies. And because of that, the valuations are still attractive, right? They quietly and consistently compound over long periods of time without coming into the limelight, which also means that you don't have to worry about valuations, taking profits, buying into drawdowns, and so on. So we have an underweight position in tech, overweight in industrials. We have underweight in large cap, overweight on small and mid caps. Like you said, most of the action in the US has been restricted to the top 10, 20 stocks. There are a whole host of great companies below that which haven't really participated in this, which present really compelling investment opportunities. And we positioned very strongly for an impending AI crash. We won't wish for it, but yet if it does happen, we'll act as a good compliment.
Thank you, thank you. Don't want to hold up the proceedings. Take it offline. Yeah.
Okay. Sure.
Thank you, Pramod. That was a very insightful presentation. And yeah, the kind of opportunities that people can access through AIF and PMS structure, much wider, more asset classes, and I guess more nimble strategies, more focused strategies, different asset classes. So wonderful.
Thank you.
And let's have a big round of applause for Pramod.